Sounds good. Hello, everyone. Oh, wait, let me try to mute everyone. All right. Welcome, everybody. We'll give everybody a couple more minutes to log on in before we jump in and get started. And can somebody in the chat let me know if you can see my screen? Can everybody see that okay? Oh, there we go. Oh, okay, chat is disabled, but I can see your screen. Thank you, and welcome, both of you who just answered that question at the same time at 6:03. All right, we'll give everybody about another 45 seconds or so before we launch it off. Feel free to pop any questions that you have inside of the Q&A section, and I'll go ahead and do my best to get to those as we go along. We don't have that much time, quite honestly, so I'm going to try to ramp up the efforts and the speed in which we try to process some of the stuff for you guys. And then there'll be an ample amount of opportunities to dive deeper for anybody that's interested. All right, one more minute or so, we're gonna jump right in. Hope everybody's having a great evening so far. And if I could get some people in the Q&A to just drop a note about where you're at, what you do, if you're an investor, if you're a salesperson, a broker, realtor, wholesaler, whatever it is that you may be doing out there. That way I can have a better idea of how to really gear this conversation for your maximum benefit. All right, and we're gonna jump into it, you guys. So welcome to the Multifamily Masterclass. This is something that I'm putting on alongside Vestor Academy and Davon Reeves. So we're going to really touch on a few things that are going to be extremely beneficial. Some stuff you may have heard before. A lot of this stuff, I'm pretty sure is going to be relatively new to you, depending upon how advanced you are in the industry. We're going to talk about more than just the steps, right? We're going to cover the steps on one slide. That's going to take about 30 seconds. We're going to really jump into the stuff that a lot of people dismiss when it comes to making a sound investment, right? And so we're going to talk about a strategic analysis, right? So right before you even get involved with an opportunity, what you should be analyzing, some things that you should consider. We're going to talk about the asset analysis itself, or some people may call it the property analysis. We're going to talk about obviously the physical components of it, as well as where it currently lives, where it's at, the actual structure itself. We're going to talk about the market analysis, the financial analysis, which is obviously the most important, but you can't dismiss any of these analysis. Again, and a lot of people do, they think they can get some financials, look at some performance that occurred in the past, and then make a sound investment decision based off of that. That's what we normally see. And that's not how you want to invest in multifamily real estate, quite honestly. We're going to talk about the acquisition process. We're going to discuss the operations, and we're going to also discuss exit strategies. Anybody that does any sort of investment should have some sort of exit strategy for your dollars, right? And again, this isn't going to be some super simple basic course. I'm not going to go too in depth because again, we have a limited amount of time, but this is going to be some stuff that you're really going to want to probably take some notes, maybe some screenshots. Ooh, before I go to the next slide, I'm going to take a look at these Q&As. Welcome, 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 welcome. Good question. Great question. We'll answer that for sure. And I'm actually going to address that. All right, so moving along. A little bit about me. I am Adrian Provost. For those who don't know, I'm the owner of Realty One Group Terminus, the official real estate organization affiliate for Realty One Group. I'm the founder and CEO of Level, which is a real estate investment and development organization. It's a multinational organization. I'm the branch partner at the Atlanta office for Tap Money, which is a mortgage brokerage firm. I'm a certified real estate coach. Obviously, I have my real estate broker's license. I have my appraiser license. I have my loan originator license. So I've been at this industry from all sorts of aspects. And obviously, as an investor, there's no license for that. But that as well. So comes to real estate investing, pretty good. Sales, pretty good. Peak performance, pretty good. Tolerance for incompetency, not so much, right? So I like people who are go-getters who actually want to execute on what we're talking about, not just come in and waste the space from someone else that could have been here, in your slot. So this is what most of you guys probably thought you were going to come in here and see, and I'm going to show it to you for about 15 seconds, like I said. Then we're going to jump into some really good stuff. One, obviously, you have to identify a multifamily asset, a good, sound opportunity, right? Again, this is the very, 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 very basics. But most people stop at this, and that is absolutely not what you want to do. This is, like I said, the basics. Again, identify the property, of course. You get it under contract, of course. You do due diligence. You get it funded. You secure legitimate property management, depending upon your investment strategy, of course. If you don't have something that's in-house, then you close on the deal. These are the steps that we see, as I mentioned, all the time, with no real effort given to the analysis outside of some very basic financial underwriting. And again, you'll screw yourself up pretty fast if you don't dive deeper into these various components, but most importantly, actually coming up and formulating a strategy before you jump into any of this stuff, right? You should know exactly what you're doing. You should know exactly what sort of yield you're targeting for this investment. You should know exactly what you want to do at the, once the investment ends. And also have a few different options, right? Because it never always goes 100% as planned. So you should have multiple exit strategies, quite honestly, but you should have the main goal and emphasis, right? So strategic analysis. The strategic analysis is going to consist of multiple analysis. So you're going to have, obviously, again, the asset or property analysis. We're going to be talking about, location of the property. Where is it located? Location, location, location. That sounds very cliche, but it's absolutely true. I can't do anything about the location, but I can do something to the property, right? I could fix up the property incredibly and spend millions of dollars in capital expenditure and still not get the value that I want because it's in the wrong location. I can't change the location, right? Again, of course, you can, depending upon what sort of investment strategy you're implementing, it may make sense, for you to do certain things like be in a certain location so you can, build affordable housing or something of that nature. Again, if it fits your investment philosophy, it's totally different. But for the sake of our conversation, you can't change the location. You want to absolutely buy because of the location as a part of the analysis. You can't dismiss that just because you fall in love with a particular property. Again, site, not just the property itself, but where it's positioned in that market, right? You might have something in an incredible city and it's located in a horrible submarket. And again, these are things that you want to really consider before you're pulling the trigger on buying that investment. again, we want to consider the legal components. We want to consider the political components, especially if you're doing something like a conversion, like an office conversion to multifamily or something like that. You want to make sure that it's a sound investment and you're handling the feasibility of it up front, right? You don't want to go down the path of spending a ton of money doing due diligence for you to find out that this property wasn't a fit for you when you could have did some simple analysis and understood that from the jump. Market analysis. So obviously we're considering the competitive set. Obviously historical performance is a big contributor to what a market value of an asset is going to be. However, it's not the end all be all, and it's probably not something that you should make your buying decision based off of. And you'll see that towards the end of the conversation here. But essentially, you want to make sure that you understand the present value of that asset, not the historical nature of it, not what happened in the past, not what the people who operated the property that you're buying it from. I mean, that's a certain component, but that's not the end all be all. There's more work that you have to do than just analyzing their numbers. And even if you verify their numbers, right? Let's say you get it directly from their accountant, their CPA, or the property management. Let's say it's verifiable financials. You still have to do more work than just going based off of their numbers. And again, we'll touch on that a little bit too. You want to consider the supply and demand, right? The projections of the rent rate and the absorption rate, everything in regards to that particular asset type, in this case, multifamily, and what that means for that market, right? Economic features, economic components, economic drivers. You want to know, okay, if I'm centrally located between 5 universities, well, chances are a portion of my tenant base is going to be from these universities, right? And then we take that into consideration when we're making our investment analysis and financial analysis and doing this complete overall strategic analysis. Again, you want to know where you're going before you jump into this. You don't want to just buy a property for the sake of saying you own a multifamily property, and you slap your name on it and it's a property that you should have never bought in the first place, right? Financial analysis, as I mentioned, which is probably the most important component of all of this, right? It's all about making money. We're trying to figure out how can we maximize our wealth? What can I do to put more money in my pocket, in my family's pocket, in my investor's pocket, whatever it may be. Ultimately, that's the bottom line. We need to make sure those cash flows are positive, And again, some people may say not always. Negative cash flows can be okay. We're not going that deep into it. Obviously, we want to do all positive cash flow. Yes, you can showcase negative cash flows and do certain things with that when it comes to discounting and taxes and things of that nature. But we want actual positive cash flow coming into our pockets as an operator of these assets, right? We're going to again discuss the acquisition process, what that looks like. Very basic. Very straightforward, but a lot of moving parts, right? You need to know what you're doing before you get yourself into a deal. Operations. This could make or break your entire investment. And you should always have a sound investment on the entry, right? That's one of those things that's just a given, right? You want to make a good buy up front. But the way you operate that asset is going to be a huge factor in regards to how it's going to perform, right? You can't think that you can just hire some local property management company and they're going to be able to generate the sort of yield that you're looking for because you own it. Trust me, it doesn't work like that. So we also want to know, depending upon your investment strategy, are you the asset manager, right? Do you have a third-party asset management company outside of the property management company? We're not talking about the same thing here, right? Accounting, what do those practices look like, right? Leasing, some people don't have the property manager lease, right? So you want to have all of these operational components already together, right? Depending upon what sort of asset you're getting ready to acquire. Most importantly, what's the exit strategy? Right? Are we looking to acquire this property so we can hold it long term? Are we looking to do a refi cash out, right? We want to go in, buy it, renovate it, stabilize it, right? And then we do a refi cash out. Do we want to sell and disperse those returns, right? If we're doing a syndication or something like that, and we have an investor that we have to pay back and make whole, and we know that the whole premise of this entire opportunity was to sell and disperse, right? Are we going to exchange it? Are we doing a 1031 exchange? Are we pushing our taxes back, right? And are we increasing the value of the dollar that we just spent and moving it over to another investment? So there's a lot of different things and different components that you, again, want to consider, especially for people who are just getting started. And I take it that most people on this call are just getting started, right? So you don't want to just jump into it just because it sounds good or because you heard somebody say this about it or that about it. And a lot of times you'll find that the people that talk about it, a lot of them haven't really done it, so it's like it's a small fraction of people that's actually done it, but they might be good at explaining how to get it done. So I mean, it's a big difference from experience and practical approaches versus just the theory of it, right? So that brings me to your success plan. And very basic, very straightforward steps that you can take to really put yourself in a position to win. Just like I tell all of my real estate consultants and advisors, you want to become an expert in whatever it is that you're doing. If you're out there helping people in any capacity, you want to be an expert in what it is that you're helping them with. And I'm pretty sure you heard that all the time, right? And especially in the real estate world. But you want to make sure you're doing the research to understand what it is you're getting into and to make sure that you're making a sound investment, right? Which is part of the reason why you're on this call today. So you can figure out what it is that you don't know, so you can get some tools, so you can get some tricks, so you can get some tips, right? You want to make sure that you connect and build rapport with people like myself, quite honestly, multifamily brokers, owners, property managers. I own a property management company as well, but that's not something that we practice in. That's for our own investments. But you want to get in contact with these people. You want to make sure you have a strong team. You want to go out there and actually get dirty, tour properties, feel them, see them, smell them, have conversations with the on-site leasing officers, and see what these communities are about. Literally do your research. And obviously, again, people's practices are completely varied on this call. We have some people who have never purchased any sort of real estate in their life on this call. Then we have some people who do this on a professional level, but for the vast majority of you, it's brand new people looking to get in. And that's why I didn't want to just stick at the first slide that I showed you that everybody else tells you about. It's like, come on, anybody can understand. You don't even have to know real estate to know that those are the steps that you need to do, right? I feel like all of you guys would have been super disappointed if I elaborated on that first slide that I showed you. That's not what it's about. That's the way to get there for sure, but there's so much more involved. And you need to be an expert. You need to have boots on the ground and feel these opportunities out, not just look at them online and think that that's going to be sufficient, because it will not be when you're trying to make a sound investment decision. You want to have your funding sources lined up. Again, I'm a lender as well, so of course I could connect you on that end too. But regardless if it's me or somebody else, you need to have the funding together. You don't want to go out there and actually identify an opportunity that's incredible, that's life-changing, and then you don't have the funds available to go and get it done. And I'll be honest with you, that's going to be the easiest part if you have everything aligned properly, right? If you really position yourself to go out there and win, and you're really hungry and you're looking to make an impact in this industry, the money is going to flow to you. Again, there's a lot of tighter lending requirements right now and guidelines, but again, there's always a way, and there's always an appetite for a good multifamily opportunity. So don't get discouraged by whatever the market is saying at the moment. You want to make sure that you position yourself as an expert, as a professional, to really be able to get it done when it's time to go. A quote of mine: everything that you will become is first conceived through your mindset, and then controlled by your thoughts, and ultimately created by your actions, right? That's a quote that I've came up with that I live by. I think that obviously you have to have the mindset. It's bigger than just the thought or the idea. You have to have the actual mindset to be able to get it done. And then your thoughts play into that, right? But most importantly, it's those actions that you put behind those thoughts. So, and again, at least you guys took the step to gather additional information to really improve your business. So I applaud you all for that. All right, moving forward. Discussing what we're going to be talking about specifically is smaller multifamily. Would I buy an 8-unit? Maybe not now. Maybe if I were getting 3 8 units or something like that at the same time. Would I buy a 6-unit? Probably not. Depends upon a lot of circumstances. I wouldn't completely dismiss it. It would depend upon what kind of yield I'm going to get, what kind of return I'm going to get, how I have to acquire it, how long I have to hold it, right? So there's a lot of different components that would make me make that decision. But my sweet spot has always been that 10 to 50 units. I acquired a lot of stuff. One of the larger ones that I did on an individual principal basis was 100 units, and it was in a piss poor community, and it really taught me a lot about buying right up front. And this is why you want to make sure you take those extra steps, right? And then this is coming from somebody who's worked at the #1 sales organization for investment sales in the entire country, right? As a multifamily advisor. And I still went out there and made a poor decision because I didn't completely analyze what I should have before, pulling the trigger on it. But I find that there's a lot of yield to be had in this 10 to 50 unit count, right? There's a lot of opportunities. For you guys, it's a much lower barrier to entry, right? You can get into these opportunities with a lot less investor participation, right? So you don't need to get as many people to come together for the equity, right? You mitigate the risk, especially if you're dealing with somebody else's money. I'm a big believer in going big and doing everything big in life. But again, you can make big returns in the 10 to 50 unit space, right? And again, mitigate that risk. And I can have multiple apartment complexes right in that sweet spot. And again, my unit count will go up and my cash flow will go up, and my investors' returns will go up. But I don't necessarily always have to go. And this isn't to say that I would never buy another 100 unit again. I absolutely would. And I have since then. But again, that was the first, and probably not by myself, depending upon the class of it. It would probably be class A if I'm going 100 unit plus. But it's one of those situations to where you want to make sure that it works for your investment strategy, right? Everybody's risk tolerance is different. You don't have the same risk tolerance as I do, right? And I don't have the same risk tolerance as Warren Buffett, right? So everybody's different when it comes to what they're looking for an investment. That's why one deal could work for you, one deal could work for them, or none of them could work for me, right? Creative financing is out there still. We do all kind of stuff, that we can get you in a deal if the deal is good enough, and if the principal is sound enough, and if the investment team is put together properly, the money is there for sure. Again, smaller equity investment. You don't need quite as much to really get it going and to be able to build and to scale in a smart way, not just a fast way, but a smart, effective, efficient way, right? From my experience, you see a lot higher cash on cash returns as well, right? We're seeing greater internal rate of return, right? And the IRR, for those that aren't familiar, just look at it like the interest that I'm making on the interest, right? So the money that I'm making on the money that I put up, the return that I'm getting on that, right? So that's the internal rate of return. You're looking at less competition, right? Much less competition, and less sophisticated competition. I'm not competing when I'm doing class A opportunities. I'm competing against people who do this with a lot of money, right? So their deal isn't going to look like my deal. Not to say that we can't buy the same asset, but their deal isn't going to look like my deal is going to look, right? The capital stack is going to be completely different, right? The players and participants are going to be completely different. But again, so the competition, I can go out here and eat these 10 to 50 units up all day long if they make sense. And I'm not a fan. I got a lot of friends and partners that are wholesalers, but I don't wholesale. I think I won't even go into what I think about wholesaling. But wholesaling, there's the potential for wholesaling for those who are interested in that sort of thing. You try to wholesale a 200 unit complex and see what happened to you. But again, these smaller units, and I would say getting up to 50 might be a little bit more sketchy from a wholesale perspective, but I've seen it, you can get it done. But again, living in that 8 to 12 unit range, you can wholesale those things all day long. But again, that's not my game. That's not my market. That's not what I participate in. So that's for somebody else to coach you on. But again, you can win big playing small. And as a newer investor, what I would say too is, even if you go on a more conservative route and chase something that's, or not chase, but acquire something that's between 10 to 50 units, don't go out there and do a complete gut job type rental. Like, don't put yourself in especially if you haven't done it before and you don't have the team to really be able to get that done, that probably isn't the opportunity for you. Just keep finding those deals, keep underwriting those deals, keep connecting with, various owners of these assets, various brokers, and really lean on them to be able to help you make some money. Don't go out there and shoot yourself in the foot. So another reason why I love multifamily and I love this smaller 10 to 50 unit. And again, 10 units is a lot to some people. It would have to be the most incredible opportunity from an investment standpoint in a long time for me to want to consider something that's less than 10 units. Unless it's like in a different country that was really attractive, that had a lot of, that made a lot of sense or something. 10, I would say, again, 10 to 50 units is going to be the sweet spot. 100 unit plus is great. And I'm not saying, again, don't stop yourself from going there, but don't get caught up in a unit count. And again, if I have two complexes, I'm at 100 units anyway, if they're both 50 units. So don't look at it from a scalability perspective, look at it from a yield perspective. How much money am I going to generate off of this asset? Don't just want to be like, oh, I have 600 units under my belt. Who cares if they're all duds and you lose on them all the time, right? There's a lack of housing inventory everywhere. Can't think of a major city in America or a secondary city in America that doesn't have enough housing, especially in Greater Atlanta where I'm at. I mean, there's not enough housing, especially affordable housing, but it doesn't stop at affordable. There's not enough market rate housing either. So there's a lot of opportunity to go in and be positioned to continuously receive nice yields, bar some sort of event that's out of our hands like COVID-19. Outside of something like that, we're gonna always be in a position from a multifamily housing sector to be able to see some decent yields and returns. We can't always expect them to be galactic returns, but they're going to be decent, right? And again, you want to in doing this, you don't want to just buy, again, multifamily for the sake of buying multifamily. You want to weigh that investment against something else, right? Because at the end of the day, we're talking about making money on the money that we're investing, right? So if I'm putting $1 here in this multifamily asset and the chances of me making X amount over this amount of time is this versus me going to a stock or a bond or something else and doing the same sort of scenario with that same dollar over that time period and make up for the differences, then I can't really say I made a sound investment decision. All I did was run some numbers off of a piece of paper that somebody gave me and did a little bit of research, right? So you want to make sure that, because again, this is investments. My dollar is my dollar regardless of where it's at. So I want to make sure it's making me as much money as possible when I'm putting it out there, right? And again, in some instances, that's not necessarily the overall goal. Some people want the yield and they could care less about certain aspects of it, but again, that goes deeper into the actual philosophy of investing and why you're investing and what you're investing at that time, right? Again, smaller units have a unit count, that is, have a shallower learning curve, right? So you don't have to be the most sophisticated individual in the world to get this stuff, man. It's super, super straightforward. And the leases are very straightforward. The leases, depending upon, variable circumstances, are normally annually, right? Some people like office and retail because they might have a tenant that's there for 5, 6, 7, 8 years. That's fine, cool. And whatever those leases say in regards to how you bump up those rents, that's on you. But for me, I love the opportunity that exists with multifamily. I think it's incredible. And I think that regardless of what happens, we're always going to have somewhere that we need to live, right? Whereas we see now that that's not always the case for office buildings, right? And which is why we're going to see a ton of office buildings in every single city and community that will allow it converting over to more multifamily opportunities. So be on the lookout for that. Less sophisticated and relatively easy to understand versus other commercial asset types like we just discussed. And it's easier to understand the leases and the operations for the most part, right? Very straightforward underwriting principles, very, very simple to get. Available financing. There's so much money for multifamily assets that it's ridiculous. It's really something that's out there and available for those who know how to get it. It's right there. Again, things change, terms change, but it's out there because there's always a strong appetite for multifamily if the deal is good. Right? Plenty of lenders are willing to loan on multifamily assets due to their consistent stream of income and easily projected revenues. I can see how much money I'm going to be getting, and I can account for it pretty accurately, right? And that goes back into you guys making a sound decision when you're investing, right? So what are we looking to do here? We're looking to maximize our wealth, right? And we have to make some decisions when we're doing such, kind of what we just touched on a moment ago, right? You have other opportunities, which are called alternative investments that you'll be able to consider when you're investing. You can say, hey, I could put my buck here, I could put my buck there. Where am I going to put it? Right? You can compare those using a rate of return sort of model, if you will. Right? So these various models and various formulas will show you how much you would plan on making across the board. So you're able to really go in there and compare them when you're able to break it down. Some people don't do this. They just underwrite the deal. They don't even compare it against other multifamily assets. They just underwrite the deal and think that it's a good deal, right? And it might be a good deal. Don't get me wrong. I'm comparing these deals so we can make sure we're finding the best deal, right? Unleveraged institutional commercial real estate should provide returns that settle somewhere in between bonds and stocks, right? So don't expect the moon every time. You're not going to always knock it out of the park. On average, you're going to be able to fall somewhere from your yield return between those bonds and those stocks. So that's good. That's not bad. But again, it depends upon what your investment appetite looks like or what your partners looks like, right? These down here are a few different places where you can see some things where you can consider and compare when you're doing investments, right? You want to look at the 10-year treasury bond. And a lot of people consider that because they're looking at what I can do with my money in the 10-year treasury versus if I'm out here investing in CRE, right? Commercial real estate. What are those returns going to look like? Based off of how expensive the money is going to be to me, right? Based off of how the market is going to be telling me my property is valued, right? All of these things are extremely important to consider when you're making these investment decisions, right? The rate of return on your investment, super important, right? What's my yield going to be, right? The percent return on each dollar invested during the period invested. Sorry. Okay. The wrong way. Sorry, y'all. All right. So obviously higher risk can equal greater return. That's not always the case, but normally you're only taking a greater risk because you're expecting a greater return, right? That's pretty fair to say, I think, across the board. One way to look at this, because a lot of people look at it like just brick and mortar, right? You have to consider this as you're acquiring these cash flows and you get a building, right? So we want to look at this from an investment perspective, not only a physical real estate perspective, right? I'm looking at the money that I'm going to be receiving if I buy this, right? So don't, a lot of people get caught up on just the physical aspects of it. And they think that they're doing a good job with the financials until their year one happens. And they're like, that is not what we penciled out when we underwrote this thing. Because they were looking at the historical performance, right? They were making an investment today based off of what's happened to this property owner in the past, in that market in which they experienced that, right? It's not the same thing. The value is not the same. And the value to me is not the same value to them, right? And so again, that's what you have to come to terms with. And you have to understand too, you'll get a lot more no's and a lot more contracts denied simply because you're going to be getting a better deal. Everybody isn't going to see that it's a fair deal for them because it makes it a fair deal for you. And that's perfectly fine. You just got to have enough deal flow where you keep going through the deals, right? And then again, you still compare those deals against each other and against alternative investments. Those objectives, right? I don't know if you guys can see, this is pretty small, but the investment objectives. Are you a passive investor? Do you want to just passively invest in multifamily? A lot of people probably should, instead of trying to be operators or syndicators, you know, because it's relatively easy to get out there and do it. Anybody on this call right now could literally go out there and do it right now as we speak. But that doesn't mean it's the most appropriate thing for you as an investor, depending upon what you want in return for your dollar, right? So again, are you a passive investor? Or are you just looking to contribute some equity and have an equity position in it? Are you a lender and you're just looking to get some debt return, right? Are you a professional investor where you want to go in and buy it, improve it, stabilize the asset, then season the NOI, right? And then you do your refi cash out. You know, and you season the NOI, the net operating income, you make that nice and juicy for the person who's going to come buy it. Because again, if they're a savvy, sophisticated investor like me, I'm going to need to see that happen. I'm not worried about your pro forma projections, what you're expecting to get. That has nothing to do with me and how I value the property right now. If I see real rents at $1,500 per month or $2,500 per month, and that's what you're actually receiving, that's a lot different than you getting $1,750 per month and telling me that, oh, the rents can be $2,500 if this happens, right? And you want to have it seasoned. You want to showcase that it's legitimate and it's occurred over time. And then I'll go out there and then I can use that for my underwriting. Are you a holder? Are you someone who's looking to buy, improve the property, you know, stabilize it, receive the cash flow benefits, and then hold on to it? And you keep holding on to it. Are you a syndicator? A syndicator is going to have to go out there. They're going to have to buy the asset. Obviously, they have to have the funding to do so. So they're going to have these equity investors. They're going to improve it. They're also going to stabilize it. They're also going to season that NOI, right? Because they need the largest return possible for themselves and that investor. Then they're going to sell the asset, dispose of it, and then disperse to those investors who invested with them up front, right? That equity. And again, obviously, they'll share in the proceeds. Are you in a 1031 exchange? Again, same process. We're buying it, we're improving it or renovating it, right? We're going to stabilize it, right? We don't want to sell it. We don't want to buy it, renovate it. And I'm not a big fan of complete renos when it comes to multifamily. Again, unless that's just your thing, unless you're out there to be a developer or, you know, that's what you want to do. We're buying the cash flow. If it's empty, there's no cash flow. What are we doing? That's what we're buying, right? And that's what I meant by don't get caught up on just the building, the fact that it's multifamily. Oh, it's multifamily. It's in a decent neighborhood and it's empty and we can go in and renovate and we'll get these rents and maybe. You know, and as a lender, I'm going to tax you for that, right? You're going to have to pay me a premium for me to lend my money on that. It's super risky, right? I want those cash flows coming in. I want to be secure. I want to look at this deal, putting my lender hat on. I want to look at this deal and see that my debt service coverage ratio is going to be covered. You're going to be good and you're going to have your profits. And I'm good because if you're a good operator, you'll get that loan. But again, are you in a 1031 exchange? Buy, improve, stabilize cash flow, and then exchange it, right? You exchange it, you go into another asset. It doesn't have to necessarily be another multifamily, but it could be. And if you operate multifamily right, you probably would be again. But again, there's a lot of different strategies that you have to consider when you're buying it. It's bigger than just finding a property, getting it under contract. It's like, okay, right? There's so much more. Again, looking at the cash flow, right? We have most of you guys probably, I'm pretty sure, understand cap rates, right? And net operating income and things of this nature, very basic stuff. We need to take it a level further when we're talking about analysis. You have to legitimately do some research, do some work. And if you don't know how to do it, you should either be finding a way to learn about it and becoming an expert, having somebody on your team that is that expert, or not dealing with this at all and doing something else with your time and your money. right? That's how you lose really fast. And I've seen it a lot, especially with younger millennials. And I hate to see it because it's like you should have never bought this in the first place. And now we're trying to help save you, make it work. Like you should have never bought this. I don't know who sold this to you and why you thought it was a good idea, but you obviously did not do any sort of analysis. You looked at the offering memorandum that was created by the broker who was hired to sell it at a premium, and then you made your numbers work from there, right? We don't want to make our numbers work. They either work or they don't. Right? The only way we make them work is if we get that price down. Okay, they don't pencil out. Well, we got to get a lower price. Right? It's that simple. Don't force it. Don't try to make it work for the sake of having a deal. But again, we want to look at discounted cash flow analysis. Right? We want to consider the cash flows. We want to consider, and again, this all goes back to the time value of money principle. Right? My money is worth a certain amount at this time. And over time, depending upon the sort of interest it's earning, will be X amount. And that's a lot of interest, potentially, a lot of money to be accounted for, or negative cash flows to be accounted for, right? But these are things that we have to consider. It's bigger than just what happened in the past or what I think may happen in the future. We have to really, again, dig deep into the financials and understand this type of stuff and understand my dollar today is not the same as my dollar yesterday. It's not the same as my dollar a week ago, right? I see a lot of people still joining too. It started at 6. This should be recorded though, so I'm pretty sure we can get it out to everybody that's interested. NPV, net present value, right? And NPV has some limitations. Internal rate of return has some limitations, but ultimately, they're going to be a lot more accurate in regards to you making a sound decision than just going off of a cap rate or something like that. Like, oh yeah, it's a 5.5 or 6% cap rate in the market. Their NOI is this. I'm willing to offer that. Okay, like, come on, like that's super basic. And it's probably not going to be accurate because you're not accounting for so many things, let alone the time value of money, right? But again, we also want to consider the future value. We definitely don't want to pay more for it now than what the future is going to allow me to make, right? Depending upon what my exit strategy is, right? Do you have to consider compounding and discounting, taxes, right? There's some ways, again, where you can combat some of those limitations. Like you're going to have the treatment of negative cash flows, for instance, that's not going to be accounted for in the IRR. Adjustment for size, right? There's certain things that won't be accounted for in some of these formulas. So you might need to take it a step further to again, make a sound decision. We want you to make money on the entry. As soon as you get in that investment, it should be a good deal. We don't need you to get into it and then try to make it a good deal, right? Let's keep it moving. I'm trying to stay on time here. So markets. The market is bigger than just the market, right? We have the capital market. We have the space market. We have the asset market, right? With the asset market, we're talking about the transactions that's occurring with the trades of the assets. When it comes to the space market, we're talking about, the tenants, if you will, right? The capital market's obviously the money, that demand, right? The demand for real estate as an investment versus the existing space supply, right? And you can see on the graph here that there's going to be certain places that's going to really whet my appetite versus others, right? And so if you look on the right side where you see the NOI versus the value, and this is talking about the space market. So we're talking about what we're getting for rent with these assets, right? And look what I'm willing to pay. And look how that lines up with the current market rent on the other end, which is the space market, right? So the NOI on the right with the asset market and the capital market, then you have the space market on the left, and they're married, they're intertwined. And the occupancy is going to change those things. You bring that space that's currently occupied down, and I have a lot more vacancies. I'm going to pay a lot less for that, right? In regards on the capital market side. I'm not going to pay you the same thing that I would pay somebody who has a certain amount of cash flow in the same space market that you. It doesn't make sense, right? So again, once you understand some of these principles and how they work, it's easier to make a sound decision. Again, the NOI and finding a cap rate, that's very basic stuff. You need to absolutely take it a level further, right? To make sure that you're making a sound decision. This is important stuff, and it's not that difficult. Once you know how to do it and once you practice it, most people can get this stuff. I didn't put the formulas and all of that because I don't want to really just blow everybody's head off that's not familiar with this, but it's very basic stuff. Just look this stuff up and then become it. Again, if this is something that you really want to be and really make money in, become an expert in it. Don't just sit around and watch YouTube videos of people telling you the same spiel about, oh, you have to buy it. Okay, how do I buy it? Oh, well, first you have to find a good deal. And then it's like, no, there's more to it than that. Especially if I'm using other people's money. This really rubs me the wrong way as an advisor, because I see a lot of newer syndicators and I don't mean new as in age, I'm just mean new to the industry. And it's like they have no clue what they're doing. And it's sad because they're doing it with other people's money. And it's not a good look for anyone. But again, you want to take it a step further and jump into it. You don't want to just look at the cap rates and what's trading per door. What traded per door is completely historical in nature. What about now? What's the value to me for this asset right now? Where it takes us to the financials. Hopefully you guys can see this. I cannot. So I have sheets next to me. And we'll just touch on some of this stuff so you can have an idea of some of the basic things you should be looking for. Again, and if anybody wants anything in regards to like certain sheets and templates that you're interested in, even if you're not one of my coaching clients, just shoot me over an email, mail, mail at adrianprovost.com. And I'll send you, if you need something, just let me know. But this is an annual property operating data sheet. This is going to do exactly what I just said. It's going to tell you how that property operated over that last year, right? And these are things that are very important to understand. And you should probably go through the entire list and get as much information as possible and have a completed sheet for every single property that you have. We have all kind of fancy Excel spreadsheets that we use as well, and calculators that do all kind of phenomenal things. But this is very basic, and it's a good place to practice. But again, you want to be looking for the potential rental income, right? Less the vacancies and rent loss. That's what's going to get you your effective rental income. A lot of people, again, get these OMs. They're not really looking at the effective rental income. They're looking at the potential rental income. It's a difference. There might be other income that's coming in, of course, and you want to include that. You're going to have a gross operating income once you have all of that put together. Then you want to look at the expenses. For multifamily, even in this smaller unit count of 10 to 50, you want to look at somewhere between 30 to 35% expense ratio, right? So those expenses are probably going to be somewhere around 30 to 35% of whatever that NOI is, or excuse me, whatever that GOI is. And so you want to make sure that you're not going off of the broker's numbers only or just market statistics only. Especially if you see that their expense ratio is somewhere like 17% or 20%, it's like, okay, we know from experience, you're not operating this asset for 17%, right? So we're going to underwrite it at 30 or 35%, right? And so again, that's one way you can protect yourself immediately, right? And again, also taking into account that effective loss, right? You're not going to have, even if you have 50 units, they're not going to all 50 be occupied 100% of the time all year long, right? Even if you do the most incredible job and you're under market in regards to how much you're asking for rents, and you keep it really highly occupied, you never see less than the 90 percentile. You still have changes, right? You still have turnovers. You still have lease expirations, right? So there's going to be a certain amount of time in which you are not generating income for some of these units. You're going to have downtime sometimes when you have to go in and perform various maintenance acts, right? As you're turning these units. So again, you have to take that into account. You don't underwrite with some pie in the sky sort of idea of what could be great. You want to really be as conservative as possible when you're underwriting to buy. Now, when you're selling, whatever, of course, you're going to try to juice it up as much as possible. And it's up to them to make sure that they can verify, not to say lie or anything like that. Definitely don't lie. But you might say that, hey, you know, this goes here instead of here. And it's up to them to understand that. And I would just encourage you to buy right, and you won't have to worry about that kind of thing. But again, so moving back on to the APOD, you want to look at real estate taxes, personal property taxes, property insurance, off-site management, payroll expenses, other benefits and expenses, taxes for workers' comp, repairs and maintenance, utilities, right? Accounting and legal, license and permitting, advertising, supplies, miscellaneous contract services, and on and on and on. There might be additional expenses, there might be less expenses, and again, the utilities might be broken down in one way for the electrical versus the water. There might be gas, there may not. Some of that might be, you know, passed on to the tenant. It might be paid by the owner. So there's a lot of different things that, again, can be massaged throughout this APOD or throughout the operating report that they send over to you with the financials that may or may not be accurately labeled or placed in the right position. Right. So again, it's up to you to understand what you're getting into and to do research and to see these things and to get a good grasp of which direction you should go prior to, you know, moving forward with this asset. But again, the APOD is very, very straightforward, very simplistic, but very helpful, you know. And if you don't take the time to at least fill this out, you're probably in the wrong industry, quite honestly. Like, that shouldn't be that difficult. The cash flow analysis worksheet. This gets a little bit more involved, but every sheet that I'm getting ready to show you is extremely basic. So it's not something that's it's not rocket science, believe me. So with this, there are 4 components ultimately that you really want to consider. Your initial investment, right? The cash flow from the operations throughout your holding period. The cash flow from the disposition once you sell it. And then what the actual holding period is, right? So that's what this is going to be made up of. And you're going to have, again, that operating information. What you really want to do is incorporate mortgages, right? Whatever sort of liens you have on the property. Cost recovery, improvements, cost recovery for personal property. So we're talking taxes, right? Your real estate taxable income, leasing commissions, right? And then once you get all of that combined, you're going to have your net operating income for line number 7, which is the NOI. And then you want to take it a step further and reduce it by the annual debt service, the participation payments, if there are any, right? Leasing commissions, funded reserves, cash flow before taxes, which you'll get at 22. Then again, the tax liability, that's a whole nother 4 hours. So we're not going to talk about that, but you want to also incorporate that. And after that, you're going to get the true number, which is your cash flow after taxes, because all of that's important. And again, you're looking at what the cash flow is, but you didn't go this deep. And now you don't know what it's going to really be because you didn't incorporate the taxes, right? You didn't incorporate cost recovery, personal property. And again, these are different things. And there's certain percentages that are given to us, right, that we utilize to plug in that information. And some people don't want to take the extra step to do that, so they'll just go buy anything because they might have the funding available. And again, that's not doing anybody any good or any investors any good. Welcome to the people that just joined us as well. So moving on, alternative cash sales worksheet. I like this because, again, it's a good way to compare side by side various investments. And then you can really have a look at what's making the most sense for you with that dollar that you're getting ready to invest. We're going to look at the calculation of adjusted basis, right? What that basis at acquisition is. We're going to look at the calculation of capital gain on the sale. Again, this is important stuff because you're going to get taxed once you dispose of this asset, right? And if you 1031 exchange it, of course, you're pushing that, but we have to still account for it. And and the thing about it is going back to the present value versus future value. What is it going to be? What do we project the sale price to be once we dispose of that asset? It doesn't stop at just the net present value, how much we're purchasing or how much we're paying for that asset right now. It's also, what am I going to sell it for in the future? When am I going to sell it? Right? Time value of money. And so you have to really, again, take that into account when you're working on your strategy, right? You're looking at the capital gains, right? Welcome to everybody that's coming. I think that there must have clearly been some, I don't know. I think some people thought it started at 7 because a lot of people have joined, but welcome. Again, calculation of adjusted basis, calculation of capital gain on sale, calculation of sales proceeds after tax. And then what is the sale proceeds after tax? How much am I making after the taxes, right? After everything is accounted for, right? After the capital gain on the sale, right? Again, you want to take it a level further to make sure you're making a sound investment. Because again, you do this for 3 different investment opportunities, and then you see which one really makes the most sense for you. You do it on one and you have no clue because you're not comparing it against anything. And you're not taking it that step. And I'm not saying you as in everybody on the call, but most aren't, right? And again, this is how you become a sophisticated investor and how you acquire multifamily and how you position yourself to win those deals as well. Right. And again, you're able to have these conversations with the sellers to let them know why you are where you are with your number. And just because they wanted 4.5 million and I'm only willing to offer 4.23, this is exactly why. And I'll share this with them and be like, this is why. Your broker probably should have told you this before they listed it. Right. This is why I'm only going to give you 4.23. Right. And then again, that might make the difference. You might get the deal, or they might say, screw you, I still need 4.5. And then you just move on to another deal. So, we're getting there. I did good on time. I usually go over. Okay, I might still go over by like a couple of minutes, but I'm just fired through this. All right, so going back to what we just discussed, right? To bring it all home and to show you in a very basic sense of what I'm talking about. So we're looking for the middle number, present value. What is the value of this asset right now at this time? I don't care about last year or the performance of last year. I'm only using that as a component to make my final decision. But I'm not using this and using it as if it's gospel, right? Oh, you made 171.6, I'm gonna make 171.6. Absolutely not. You didn't account for for a lot of different things, right? Your expenses are BS. We know that. We run assets like this. We know it's going to be about 50K for that asset, right? So my NOI looks completely different than your NOI. The only thing we're sharing here is going to be the cap rate because we're getting that from market analysis, the market cap rate from historical performance and from the way that things are moving in the industry, right? The current economic climate, we know the cap is 5.5% for this asset, right? Cool. So I receive your financials. I receive the information provided to me by you from your lender, or excuse me, from your agent or your property manager. I'll run my numbers, right? And I get income of 165. I get expenses of 49.5. I get an NOI of 115.5. The cap is at 5.5. So I'm only willing to spend $2.1 million for this asset. Maximum. That's where I'm going. You're at 2.4, I'm at 2.1, right? I've done my additional research and I see that once I go in and operate it, the way I'm going to operate it, I'm going to be able to generate income of 185 over the life of, me improving this asset and however long I'm holding it. My expenses I'm going to move my expenses over. I'm not going to then go and put 30 or 35% of my income because I know what my expenses are. That income changed because of me, right? Which goes back to why I can't only consider these numbers. that those expenses might have been what it cost them to get to this number, but that might not be the true expense to actually operate that asset for so many reasons, right? And so again, I'm coming and I'm going in, I'm saying 5.5 cap, my number is 2.1. When I sell this asset in 4.5, 5 years, I'm only gonna be able to sell it for 2.46. You want tomorrow's money today, sir, and I'm not willing to give that to you. I'm willing to give you 2.1, right? I'm getting 2.46 on the exit. So I need these numbers to work for me on the entry, right? I'm selling it for 2.4. I know it. Once we buy it and we do what we do and we hold it and we get those cash flows, we sell it, we're selling at 2.4, given the conditions of the market in the future of what I'm projecting based off of all of my research, right? So again, don't go in there thinking that you can just, oh, well, just 2.35 and we'll be fine because we got a deal. What? No, do some research because you might lose your shirt in the interim. And those expenses might be crazy. And there might be other things that you're unaware of that's really making that value less valuable or that asset less valuable than it truly is positioned as on the market at the moment, right? So I hope you guys learned something today. Thank you. I'm gonna see if there's any. We're like I said, 2 minutes over time. So there's that. Let me stop this. Let me see if anybody has any questions. And yep, here we go. I'll see what I can do in regards to answering these. It's quite a bit. I'm gonna see if I could skim through real quick and see if there's any ones that really could be beneficial to everybody on the call. Boom, boom, boom. Darnell, good question about when you don't have the net worth for the deal, for example, a $10 million multifamily, how would you go about structuring your first few deals with someone that has the net worth? Give me a shout, mail at adrianprovost.com, mail at adrianprovost.com. And we'll get you set up. We do that all the time, help people out. Will there be a replay? Maybe. Get with me on anybody that's interested in learning more. I coach too, so if you're interested in coaching, reach out to me about that. I'm in Illinois. Do you think it's valuable to register an LLC series for real estate purchases? I am not a tax professional. I am not an attorney, so ma'am. I'm joking. Let me see. But that's really something that you want to get with a professional about in regards to how you're going to structure your entity. It's different for everybody. So, I have various types of entities. And so it depends upon what it's for. If you're going to buy a multifamily asset and you're using a capital stack that's going to include money from a lender, it's going to be a single use entity. So they're going to make you create an entity just for that asset, right? But again, in regards to how your overall entity is structured, that's something that you absolutely want to get with a tax professional with, and probably an attorney as well, and let them guide you on what's going to make the most sense for your investment outlook. Yeah, see, I got a lot of people saying that hopefully there will be a replay. My confirmation started at 7 or stayed at 7. Yeah, I think a lot of people, I think it was one of those time zone things. So I apologize about that. Anybody that missed it, that signed up, I'll get with the Vestor Academy crew and let them know that we would like to send them a replay. Because I would love for you to hear what was just discussed. Any other questions? Papa, I'm the host, but I didn't set it up. So I'm doing my best to try to converse with you all, but it looks like you'll have to pop something into the Q&A because the chat is disabled. So please, the Q&A, and then I'll be able to address anything that's continuously coming in. A lot of people are saying the same thing about the 7 o'clock thing. It's my pleasure. If you missed it too, okay, yeah. So more people are coming on too. So yeah, I think I'm pretty sure we can get you guys squared away. with the replay. We'll probably pop it up on YouTube for you as well. Because again, this was some real basic stuff, if you will. Oh, maybe I should stop recording.